The show this morning is going to be filled with tons and tons and tons of really good news, but it won't necessarily be about the stock, about Tesla stock or the stock market. Anyway, we have so much to talk about that I've started this early. The Wall Street analysts are apparently watching my show. I started warning last week, last Friday, I started saying, look, we're heading into August, the slowest month of the year. Everybody's on vacation. There's not as much trading. The traders are gone. It's usually not a very good month in terms of the market. In terms of over time, it's traded at exactly flat. That the market has gone way up, especially the NASDAQ's gone crazy this year. Everybody's going to be just looking for an opportunity to begin some kind of a sell-off. It could be a correction. There's also a need for a rotation because the NASDAQ has so outperformed the rest of the market. I didn't mention there's also a need for a rotation in bonds from the 10-year to the 2-year, or actually the opposite, where the folks have been, I'm sorry, that's right, out of the 10-year into the 2-year, because people have been buying the 10-year like crazy, but not the 2-month. So anyway, guess what? This morning we're seeing we're seeing a lot of what I've been talking about, but what we're also seeing is the pundits, the analysts, the Wall Street guys, the CNBC guys. What are they talking about this morning? Oh, that August is a slow month, that August is, and that people are looking for an opportunity. This might be the correction, et cetera, et cetera. I'll talk more about the details of that as we talk about what is causing today's correction. Oh, it's the Fitch, or is it? Okay, there's also a labor beat or two. We'll be talking about that, and much more. This is Randy Kirk. Please hit like, subscribe, and then yes, I have so many people lined up. I'm not even going to go into it. Just hit notify, and then Patreon. You get a free book. All you got to do is join. You get a free book. Simple as that. Free audiobook. And you get the choice. All right. Folks are looking for a reason to sell. They're sitting on a pile of profits. That's some of them. Others have recovered their losses, and they're sitting there going, wow, I've recovered some of my losses. Fear becomes the motivator again. Should I sell now? Should I sell some? Should I trim my portfolio because maybe the stock market is going to go down? It's gone up awfully fast. Well, guess what? I mean, I'm even wondering if I should trim a bit, but I'll tell you later what I'm going to do. All right. So let me know in the comments, what are you going to do? What are you thinking? Are you thinking you're going to trim? Are you thinking that the market's going to go down 10, 20? Is this the correction period? Is it just the NASDAQ that's going to correct and the Dow is going to stay okay? What do you think is going to happen? Let me know in the comments. And what about the Fitch downgrade? Well, okay, there's Fitch. Quite frankly, I'll be honest with you, I've never heard of Fitch before this morning, but you've got S&P and others who do rate the U.S. Credit rating. And you might remember that in 2011, the S&P downgraded the U.S. Credit rating because of the fight that was going on with Congress and the White House with regard to, whether they were going to raise the credit limits or not. So this is not the first time we've seen these kinds of credit down rates. Well, now this Fitch one comes out this morning, and they're saying, it looks kind of bad for the U.S., with regard to their debt, because they've got all this debt, massive amounts of debt, and now the interest rates are going up, and interest rates are going up. That means that the U.S. is going to have even more of a deficit because the massive amounts of interest that they're going to have to pay compared to what they were paying. I wish I'd had this show a year and a half ago. I was saying this a year and a half ago. It's one thing for the U.S. government to have all this debt when you're sitting at 1% interest or 0.5% interest or zero interest. But now when you've got 5%, 4% interest, the U.S. government's debt, the amount that they have to pay out on the debt is a massive impact on deficit spending. Well, okay, Fitch is saying that's what's going on. Therefore, we don't think that the debt is as strong, we should lower the rating. I think it's a bunch of nonsense. I think it's ridiculous. The U.S. economy is the only economy in the world right now that is really doing well. China, Europe, the UK, Japan, go down the list. They're not doing very. Russia, oh my gosh. So the U.S. economy is super strong, but Fitch says this, and what? People are looking for an excuse. That's what you're seeing this morning. There's also huge amounts of general news this morning. Let's I'll get to Tesla last, but there's a lot of great amazing, interesting Tesla news too. So much I won't even be able to get to it all. I'll have to do it later today. All right. Employment openings totaled 9.58 million. That was yesterday. That was later in the day, so I couldn't report it yesterday. So the employment openings were at 9.58 million for the month. That is edging downward from the downwardly revised 9.62 million last month. That was the lowest level of openings since April 2021 and below the 9.7 million estimate from FactSet. So we're finally seeing this number come down, but it's minuscule. There's still massive numbers of opening compared to the number of folks that are looking. Along with that, we had the JOLTS report yesterday that said that layoffs nudged down to 1.53 million. Oh, nudged down. Okay, one more labor factor that's saying that there's not a problem with the U.S. economy and or labor. Economists were watching these two data points closely for clues about the direction of the labor market. But what we're seeing, of course, is that the labor market is strong. We're definitely heading in a Goldilocks direction, said Rachel Cederberg, senior economist at the labor analytics firm Lightcast. We've got a long way to go, and we still have a very important number of openings, especially as compared to where we were pre-pandemic. We're headed in the right direction. We're seeing it, everything be in a calmer manner. Yeah, I'm still talking to people that are saying they can't find good labor. Okay, I'm seeing it all over the place. So the JOLTS report is a key indicator for the Fed as it ponders what to do at the next meeting. All right, so a variety of economic data show the U.S. economy was cruising into the second quarter. Well, no, it's better than that. Let me go on down here. I'm going to pass this up. Along with the drop in openings and layoffs, came a decline in hiring to 5.9 million, a fall of 0.2 percentage points as the share of total employment quits also slipped noticeably, dropping by nearly 300,000. Well, there's more. We'll be talking more about that too. Manufacturing is still showing it's in correction a little bit. A separate report Tuesday showed that the manufacturing sector, which reported declines in both job openings and hires for June, was still in contraction during July. The ISM Manufacturing Index registers a reading of 46.4. 50 is anything under 50 is contraction. I think this is a minor issue because then Reuters comes along and says, oh, construction spending advanced 3.5% on a year-over-year basis in June. Spending on private construction projects increased 0.5%, with investment in residential construction rising 0.9% after rebounding 2.9% in the prior month. Private construction spending had surged 1.3% in May. Spending on single-family housing projects surged 2.1% in June. So you're beginning to see some of the builders are saying, you know what, we need to build some residential housing. There is a demand, even at these high interest rates, that is still nowhere close to what's going to be needed in order to make residential housing start to ease in terms of pricing. The housing market has taken the biggest hit from the Federal Reserve's fastest monetary policy tightening cycle since the 80s. There's an acute shortage of single-family homes available for sale, and that's driving construction. So then ADP employment numbers come out this morning. ADP numbers beat by a ton again. People were expecting 100,000 or so, came out over 200,000. It's another beat. I'm looking more for Friday. Obviously, everybody is going to be looking at Friday's numbers now, wondering what the heck is going to come out on Friday. Then Reuters is reporting that on Tuesday, the Chicago Federal Reserve Bank, listen to this carefully, President Austin Goolsbee said, listen, his own decision at the next meeting in September will be driven by what's happening on prices. Many of these recent meetings have been close calls. Let that sink in. Many of the recent meetings have been close calls. We're trying to manage the transition point. That's the hardest thing when you're trying to get the timing right. In a video call with reporters, Atlanta Fed President Raphael Bostic also said she's now going to be voting. She says her turn is not going to come till next year, but she said she had grudgingly supported July's rate hike, and it's not clear at all that they need a rate hike in September. An extra reward for holding stocks so this is a different report now. Okay, so typically what you're looking at, especially in this kind of market, people are deciding, should I put my money in bonds or should I put my money in stocks? Well, an extra reward for holding stocks instead of bonds has fallen to its lowest level in 20 years. I reported on this about 3 or 4 weeks ago, but now it's getting even worse. This is threatening. This is one more threat to the bull market and a reason again for a correction. One method for gauging the value of stocks is to compare their earnings yield, calculated by dividing a company's expected earnings over the year by its stock price, to the yield of government bonds, considering the closest thing to considered to be the lowest thing that you can get in terms of risk-free return. The difference, sometimes called the equity risk premium, shows how much investors are being compensated for the additional risk of owning stocks. And right now, that isn't much. The gap between the earnings yield of the S&P 500 and the yield on a 10-year U.S. government bond dropped to about 1.1 percentage point last week, its narrowest since 2002. The spread to the yield on the 10-year Treasury inflation protected security, seen by some analysts as the better benchmark because corporate earnings tend to adjust with inflation, has similarly fallen to its lowest level since 2003, around 3.5 percentage points. So the risk premium first started shrinking in the second half of last year. As we saw bonds, the yields going up and up and up. And as inflation has been going down, we've not gotten the benefit of those turning around. Stoking the optimism. Sorry, let me back up here. The risk this year, the premium has continued to dwindle for slightly different reasons. Bond yields haven't risen as much, but stocks have taken flight, lifted by investors' growing optimism about the economy. Stoking that optimism, many believe the Fed is finally done raising short-term interest rates. With inflation showing signs of cooling, interest rate futures indicate that investors think there is only a slightly better than 30% chance that the Fed will raise rates again this year. Now, that's up from 22%. Yields on U.S. Treasuries largely reflect investors' expectations, what I've been talking about, for short-term rates over the life of the bond. So then Quartz says this: the Federal Reserve Bank of Atlanta's real-time GDP tool, it just keeps coming. Listen to this: their GDP predictor, predicting a 3.5 growth rate for the U.S. economy in the third quarter. 3.5. That is hot. Oh my goodness. What did I say about no recession? I know. They just need, I'm on a hot streak. Following strong construction and manufacturing data, the GDP tracking instrument now bumps their forecast to 3.9. The official measure of U.S. GDP will come out much later this year. This is not their official, this is nothing official about this. This is a real-time estimator, kind of like Trueflation. Okay, well, the rosy outlook follows a 2.4 GDP increase in the second quarter, outshining economists' predictions for a 1.8 rise and the first quarter's 2% uptick. To be sure, the tool isn't an official forecast. Okay, I want to be clear on that. Well, okay, let's talk about Tesla then. I'm running out of breath here. By now, you are absolutely aware that Tesla's put in a request for federal funding to help with them to build out 9 semi-charging stations between Texas and California. This would certainly be an indication that Tesla is getting ready to roll out production as per their plan in 2024 on the semi-trucks. It's also an indication of what? That they're doing it again. They're putting in the infrastructure before they start building out the production. And has Mercedes learned that? Okay, it's not Mercedes. It's I'm forgetting their darn name. Have any of the other trucking companies begun their build out of their infrastructure that they're going to need for electric trucks? Peterbilt, any of these guys? No, nobody is building out their infrastructure. Now Tesla, you know they're going to build it out anyway, whether they get the funds. But this is huge, huge news, and they're putting it where, look at Stephen Mark Ryan's, he did a great analysis this morning about where these 9 supercharger stations are going to be relative to Austin, to Corpus Christi, to the New Mexico plant, to Fremont, to even to SpaceX. I mean, you got all these materials and finished products that are going to be moving around between the various Tesla plants. And of course, these stations are going to be perfectly poised for that. All right, let's see. Elon Musk replying to Scobleezer, at Scobleezer on X, says, vehicle control, listen to this, very carefully, vehicle control is the final piece of the Tesla FSD AI puzzle. That will drop 300,000 lines of C++ control code by about 2 orders of magnitude. It is training. As I write this, our progress is currently training compute constrained, not engineer constrained. This is huge. It's being reported a little bit, but underreported. This means that everything except for vehicle control is now basically solved. Is that what it means? I think that's what it means. If you think I'm wrong, put it in the comments below. If you want to truly understand Tesla, if you want to keep your commitment strong, like I'm trying to keep my commitment strong this morning, I mean, I could do day trading. Day trading is hard on the heart. Okay, so I can do day trading right now. I can say, you know what? I think we're going to have a correction. I think it's time maybe to trim my position in Tesla. But if you don't want to panic sell the stock and you just want to say, you know what? I'd rather just have some comfort that long term it's going to be fine. Yesterday, what was the news that drove down Tesla stock? Probably that 12 vehicles reported issues with steering, that NISTA said, okay, we got to look into this. And that's the report. That's a long way from a recall. Okay, that means they got to analyze the reports. They have to go back and see whether or not it's worthy of even going deeper into the subject. They've got to contact Tesla. Tesla's got to provide them with information. They got to decide whether it was limited to 12 vehicles or might have been 24, or whether they need to recall. We don't know whether it's an over-the-air update that would solve it. We don't know anything. And yet the Tesla, apparently the stock responded to that. But what is it really responding to? What's responding to is Tesla's gone up from 102 to 255 or 265, 275 or 300 at one point. So what could happen? What is out there that could cause me to want to take those profits? That's what's going on. But you've got to keep in mind about what is coming. An entire additional Tesla is coming. Energy storage in 3 years will be as big as the entire line of the entire company is right now. It's at about 100 billion, and energy will be at 100 billion in 3 years. You got to keep it in context, okay? This is just energy and Tesla, and when on top of that you've got FSD, Robotaxi, Dojo, and of course Optimus. All of those things are going to grow the company to crazy numbers. So if you don't want to get involved in day trading, because what happens with day trading? Okay, I decided today to trim my position. And what happens later today? There's other news. Or later today, some people start doing the opposite of profit taking. They start going, bargain shopping. And all of a sudden, you got a crazy increase in the stock, because I've already said I believe that Tesla is detached from the rest of the market. It's going to go on its own speed right now. It doesn't care about the NASDAQ. It doesn't care about the S&P. It doesn't care about the Cathie Wood stocks. It's under its own motivation right now, because it is unlike any other company in history. And the trajectory for the next 2 years is mind-numbingly crazy. Well, after dropping yesterday, probably because of that recall fear, I still expect Tesla and the market to move up. Yes, I think there could be a correction. And it could happen at any time. It could happen today. It could start today. It could be over in 2 weeks. It could start in 2 weeks and be over 2 weeks later. It'll be a 10% or 20% correction at the very most. So maybe not. But this is what I think. And I'm not an investment advisor, and I don't know what I'm talking about. And I've been right a lot, and I could be completely wrong this time. So please keep that in mind. But watch for additional market moving news. Yeah, let's take a look. Let's see where we are at 652. I know I've been talking a long time. So Tesla hit 255, just under 255. It's bouncing around 255, back up a little bit to 257 right now as I'm recording this, but headed down a tad. Anyway, 255, I think, is going to be the bottom for Tesla. I do not think it's going to break below 255. Again, I'm probably wrong, but I've been right about 255 a few times, and 255 is a pretty hard stop. So it's going to be really hard for it to break below 255. Okay, what about the overall market? So the Dow is down. It is down 0.4%. The NASDAQ, of course, because what am I talking about? Rotation. It is down 1.37%. S&P down 0.8%. And Tesla down 1.35%, about the same as the NASDAQ, but again, nothing to do with anything. it is up against this hard number, the 255. And then what do we got going on in the rest of it here? Just a second. Let's look at what we got is the crypto is still bouncing around the low 29s. We got the dollar shrugging off Fitch's U.S. credit rating downgrade. The yen is rallying. Why? Because the Japanese government is trying to deal with their problems, and so some of that is causing the yen to be stronger this morning. Gold is firming, but it's still very high, up at 1981, but way off of it was way up over 2000 a couple of days ago. Oil is coming down a little bit, but still at 81. Not good. I don't like that. Bonds. Okay, what we have taking place here, worthy of a couple of seconds of commentary. What we're seeing is a reversal of the yield inversion. So the 10-year is up strongly, the 2-year is down, and the 2-month is down. That is a reversal. It is one data point. It is for 2 hours. I mean, starting this morning, it's still reversing. Is there anything to the potential for this reversal? Is the Fitch report? Is the problem with the U.S. economy in terms of this debt management? Is any of that? What is anybody comment below if you know what an inversion reversal is going to mean? The inversion has been going on since July of last year. It has been, I believe, nothing to do with any predictive power with regard to recession, obviously, based on all the news you just heard. So tell me if you know anything about this, of what happens when this inversion inverts. That'll be very valuable to know. Okay, listen, if you didn't see my hour and 15-minute long interview with Brian Wang yesterday, it's got a card above. It is the best piece of content I think that I've ever produced on the channel. It's certainly a very big piece of content. It's super insightful. You need to go back. You need to listen to the entire thing. I'm going to chunk it up. I'm going to break it up. Don't get mad at me for reproducing this, because I'm going to make it into 4 chunks. And so, when you see it come out again, you say, "Oh, Randy, you've already done that piece." Well, yeah, it's so valuable. It needs to be repeated. But if you want to watch the whole thing right now, it's an hour and 50-minute long, but the whole thing is incredible. So much news, you just can't believe it. Okay, hit like, hit subscribe, hit notify. That's all I got. If that isn't enough, it's been great talking to you.